Long term, there's clearly a problem with taking on too much debt. That is clear. We've seen that over the last decade. Debt is not good. On the other hand, one's got to look at the short term and look at the degree of stimulus that governments and central banks are actually throwing at their economies. And if you look at these numbers, they're absolutely awesome. We're talking about something like 6 to 7 trillion in QE packages alone. That would take central bank balance sheets up by about 1/3 from their pre-crisis levels or pre-virus crisis levels. And you're talking about something like the equivalent of a 40% jump in global liquidity. These are numbers we've just never seen before. Fiscal deficits on the IMF numbers could be, we could be seeing a 6.5% of GDP stimulus globally. So there's an awful lot of money going into markets, and that is likely to cause, I would suggest, an inflation problem coming into 2021. And that's one of the things that markets are not yet focused on. US monetary growth this year could conservatively be in the 15 to 20% range. So if you take a trend growth in the US economy at best at 3%, we're talking probably 5 to 10% inflation, CPI inflation, at some stage in the next 2 years.
So that's the longer term. In the short term here, the markets, it seems to me, have been incredibly sensitive to the rise in new coronavirus infections. We saw that remarkable turnaround through the session yesterday where we thought we were going to see a second day of positive closes, and yet that 900-point gain just melted away in the Dow to the close here. Is that the key benchmark for whether these rallies can last, whether we see the flattening of the infection curve and a drop in deaths?
Yes, there's no question the markets are being driven by near-term virus statistics. That's clear. But if you look at the degree of risk aversion going on in markets, it's unparalleled. We've not seen anything like this before. The shift into safe assets like treasuries and cash has just been without previous experience. To give you an idea, we look at risk appetite indexes worldwide. The low points are normally about -40 on a scale of +50 to -50. We're looking at numbers now of near a -80. These numbers have just never been seen before, even if you go back 50 years. So we're talking about a degree of risk aversion which is unparalleled. Equity markets look cheap on certainly a 2-year view.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.